This is the first of a three-part series in which we're looking at the preparation of consolidated working papers for upstream sales. Problem 6.7 deals with the cost method. Now you would recall that when we're looking at upstream sales, the subsidiary is selling to the parent compared to downstream sales in which the parent is selling to the sub. Now, whichever method we're using, we must remember that any profit or loss that has not been realized through the subsequent sales to third parties, that is persons outside of the entities, is defined as unrealized intercompany profit or loss, and this must be eliminated in the preparation of the consolidated financial statements. Now, in problem 6.7, the data reflects that Pride Corporation owns 90% of the common stock of Seagull. The company was purchased for $810,000 on the 1st of January 2012, when the beginning retained earnings was $150,000. We are now in the year 2016, and you're required to prepare the worksheet entries and consolidated working papers for the year ended December 31, 2016. So we purchased on January 1, 2012, and we're preparing the statements at December 31, 2016. So we have to deal with issues related to post-acquisition profits. Now the financial statements have been prepared for the parent. So you have the income statement for the parent, and you have the income statement for the sub. In addition, a statement of retained earnings for the parent and a statement of retained earnings for the sub. Balance sheet for the parent and balance sheet for the sub. You would note that since we're using the cost method, that the investment in Seagull appears here at $810,000, which is the original amount that was paid for the company. So no change is made to the investment account unless there is a liquidated dividend. Now, reminding you that the stock was purchased on January 1, 2012, and on that date you paid $810,000, and the retained earnings of the sub was $150,000. Now you would note from looking at the statement of retained earnings that the retained earnings now of the subsidiary at January 1, 2016 is now $180,000. So we therefore recognize that the increase in retained earnings post-acquisition is now $30,000, which is $150,000 taken from $180,000, of which 90% of that belongs to the parent, which accounts to $27,000. So, to establish the reciprocity or to convert to equity at the beginning of January 2016, we would debit the investment account with $27,000 and credit the beginning retained earnings of the parent with $27,000. So on the worksheet, the investment in Seagull's account is debited $27,000, and the beginning retained earnings of the parent is credited with $27,000. Now on to dealing with the issues relating to intercompany sales and any realized profit in the beginning inventory and unrealized profit in ending inventory. Now you would note in this particular question that the inventory of the parent includes $45,000 of profit. So here you're given the actual profit and not the value of the beginning inventory. Whereas here, the ending inventory, you're given the value of the ending inventory. So you must note these carefully when preparing your adjustments. So dealing with the intercompany sales, we have $300,000, which were the sales that were sold from the subsequent to the parent, and these will include a markup of 20% on the selling price. So 20% of 300,000 is 60, which means that the intercompany cost of goods sold will be 240. In addition, we are also told that 75,000 of these goods that were purchased in 2016 remain on hand. So 75,000 is your ending inventory, and therefore 15% of 20% of 75,000 is 15,000. So our entries first to eliminate the intercompany sales would reflect a debit to the sales account and a credit to the purchases account, and the entry to eliminate the unrealized profit in ending inventory will result with a debit to the ending inventory in the cost of sales account and a credit to the inventory account in the balance sheet. This will reduce the inventory from the purchase price back down to the cost. So this will reduce it from 75,000 that is included in the inventory of the parent to 60 by making a credit to the inventory in the balance sheet. So these entries here, we debit in sales with 300,000 to reduce the sales, and we're reducing the cost of goods sold by a debit to the to the purchases of 300,000. Also in the income statement, the ending inventory is debited with 15,000. This will reduce the 210 inventory of the parent, moving it from the 75,000 down to 60. And we will go to the balance sheet where a credit is made in the inventory account on the worksheet for 15,000. You would recall that the beginning inventory had $45,000 of profit. So you were given the profit, and that profit, which was unrealized in 2015, is now realized in 2016. Therefore, we would debit the beginning retained earnings of the parent with 90% of this, because we own 90% of the company, and 90% of the 45 is 4,500. The non-controlling interest, their account will be debited with 10%, which is 4,500, and the credit would go to the beginning inventory in the income statement in the cost of goods account of 45,000 to reflect this. So this is to recognize the gross profit in inventory that was deferred in 2015 and reduce the consolidated income and NCI for their share of unrealized profit at the beginning of the year. So the entries here, you will see in the income statement, a credit is made to the beginning inventory for the 4,500 or 45,000, that should be, and we would have debited our company with 4,500, which is 90% of 45,000, and the NCI is 4,500, which is 10% of 45,000. The other entries that we will now make would be to eliminate the intercompany dividends and to eliminate the investment account and create the NCI account. Now, dividend income, you would notice 60,000 times 90%, which is 54,000. So in the income statement of the parent, dividend income is reflected at 54,000. The dividend declared of the sub is 60,000, for which we must eliminate 54,000. And to deal with the investment account has now to be eliminated. Now the investment account now stands at $837,000, which is the original 810, plus the 27,000 that has been allocated for a share of post-acquisition profits. So the beginning retained earnings of the subsidiary of $180,000 is eliminated. The common stock of $750,000 is eliminated, but the non-controlling interest would be $93,000, because this is what the NCI share of the beginning retained earnings, 10%, the common stock, plus any increase or decrease in the amount that has been originally invested in the company. So those entries here, you're going to see the dividend income of 54 is debited with 54 in the eliminations column. This would completely eliminate that account. And in the retained earnings statement, dividends declared credited with 54,006 is captured in the NCI column. The investment account is credited with 837,000, and the NCI is credited with 93,000. And you would note then that the beginning retained earnings here is debited with 180, and the common stock, and this should be, 750,000 and not 75,000. It should be 750,000. Now, you would also recognize that an entry has to be made for the parent share of the income of the sub. Now, this has been prepared to enable you to calculate what is the parent share of net income. Now, the net income given here on this statement is $1,250,000. However, you would recall that there was some profit that has been realized. So, in this of 15,000 and there's some unrealized. So when we subtract the 15,000 from the beginning inventory and we add the 45,000 that has been included in the profit of prior years, you will then have a revised subsidiary income of 101,250. Of this, 90% belongs to the parent. So 90% of this is 91,125, and the sub would get 10%, which is 10,125. So the non-controlling interest in the income statement, therefore, will have $10,125,000, and that is subtracted from the net income here of $150,750, so that the $140,625 is what belongs to the parent. The entire line here, net income line, it then appears in the statement of retained earnings, and with all the other adjustments made, the retained earnings account is now revised, and this line is transferred directly into the retained earnings in the balance sheet. We will now go through the process of calculating our consolidated balances. So your cash is 93 plus 75, 186. The accounts receivable, no change. This now with your inventory, 210, 172 minus 15, 367, 500. The investment account has been eliminated. Recall 810 plus the 27 in post-acquisition profits minus 837. And we have your total assets here. The adjustments, you would note that the retained earnings is the retained earnings of the parent. The common stock of 1,200,000 of the parent is what ends up in the consolidated. The minority interest is now, you have their share of the retained earnings is 4,112. You had 93,000 minus the 45, which is 88,500, giving you the NCI balance now at December 31st of 2006.